Hello and welcome to FINA403 16T Group 4's presentation. My name is Gregory Pearce. The other member of my group is Cassidy Tamisi. Unfortunately, Cassidy hasn't been able to be contactable, so I've had to run through this on my own. So we'll get started. The topic for this presentation is SME owners who cheat on taxes will get a higher price when they sell their business. Well, the first thing we need to look at is to define what we mean by cheating. So there's a couple of categories of not paying tax. One of them is tax avoidance, the other one is tax evasion. Beg your pardon. Now, although the two expressions are commonly associated, and the lines between the two are certainly not well defined, Karen B. Brown, in her book A Comparative Look at Corporate Regulation of Tax Avoidance, while stating that defining tax avoidance and tax evasion is problematic, puts forward that a generally accepted definition of tax avoidance is lawful steps taken in order to reduce or totally obviate the tax liability, making use of all the legal shortcomings and loopholes. She also states in her book that tax evasion is an unlawful manner for reducing the tax liability. The OECD has a definition for tax avoidance, and that is tax avoidance is generally used to describe the arrangement of a taxpayer's affairs that is intended to reduce his tax liability, and that although the arrangement could be strictly legal, it's usually in contradiction with the intent of the law it purports to follow. There are some historic precedents that protect the rights of taxpayers to organise their affairs in such a manner as to reduce their tax burdens. In the case of the Inland Revenue Commissioner versus the Duke of Westminster, 17, in 1936, this case is probably the most notable judicial approval of tax avoidance. Lord Tomlin observed, "Every man is entitled, if he can, order his affairs so that the tax attracting under the appropriate acts is less than it would otherwise be. If he succeeds in ordering them so as to secure this result, then however unappreciative the Commissioners of Inland Revenue or his fellow taxpayers may be of his ingenuity, he cannot be compelled to pay the increased tax." There have been several subsequent rulings that have prompted the taxpayer to work more closely within the spirit of the law, but it is generally accepted that taxpayers can organise their affairs to minimise their taxes. Therefore, for the purposes of this presentation, we consider cheating on taxes to be the unlawful practice of tax evasion rather than the, albeit frowned upon, legal tax avoidance. Some of the most common forms of tax evasion for SMEs are deliberately underreporting or omitting income. An example of this could be not declaring your cash income and only declaring the clients that pay you online or by FPOS or by credit card. Claiming false deductions, so that could be claiming your personal vehicle as a company expense, claiming all your personal utilities for your household against your company. Hiding or transferring assets or income. So an example of this could be selling a property to one of your kids at a ridiculously low price so that you in fact kept control of the asset, just didn't have legal ownership. Overstating the amount of deductions. So a good example of this would be depreciating a asset very quickly, so that your deductions for depreciation were very high, and that also has the result of giving you the opportunity of buying the asset at its scrap value and then selling it for its actual market value, which is much higher. Making false records, making false entries into records. So that could be making fraudulent invoices to the cost of goods sold, and that would reduce your tax liabilities. Maintaining two sets of books and then presenting the false books for your taxation purposes. Misusing a family trust to shelter company earnings or assets. Abusing your charitable deductions is another form of tax evasion. It's common in SMEs. So if we want to see the effect of these actions on the value of a business, we've got to look at the most common measure of assessing a company's viability or its value. And most people use accounting ratios to check the status of a company and to track its performance. There are some categories of ratios, and there's limitless amounts of ratios you can make up. However, there are some very useful commonly used ratios. And some of these are performance ratios. There's return on assets, return on equity, a profit margin, price to earnings ratio, earnings per share. There's vertical analysis, liquidity ratios that check measure the liquidity of your company, the acid test ratio, which is also called the quick ratio, and working capital. There's finance ratios, the debt ratio and debt to equity ratio, examples of these. Then activity ratios, asset turnover ratio, inventory turnover ratio. These are the types of ratios that potential buyers will be looking at to see how your company is faring, where it sits in the market. Now, almost all of the cases of tax evasion or cheating, as we've defined it, actually decrease the stated profits of the business. If they don't decrease the EBIT directly, then they affect the EBITDA. This decrease in profits has the effect of actually making the business look less attractive. So while evading taxes might give the company a little bit more money to play with, in actuality the effects on the books is to make it appear as if the company is not performing as well as it actually is. If we consider that almost all of the measures of a company's profitability are some form of profit against either some form of their assets or some form of their liabilities, no matter which measure is used, the profit is on the numerator of the equation. Therefore, if the profit is smaller, then the overall ratio will reduce. Likewise, increasing whatever measure of profit is used improves the ratio as the numerator is increased. Another thing is the super profits. The super profits are a premium which are added to the price of a business. There's many different ways that super profits can be calculated, but they all relate to some form of the profitability of the company. So what a prospective buyer will generally see when they look through the books of a company that's evading tax is lesser profit margin than the actual. So another point that we need to consider is that it's not likely that a potential buyer is going to look at purchasing a business without looking through the tax returns over at least the last 5 years. If there's difference in the tax returns and then the books that the companies are showing, it's a big warning flag to any buyer. So there's no benefit in having two sets of books in terms of selling the company. If a potential buyer sees two sets of books or sees data which is questionable, that actually puts them in a position of quite high leverage over the seller, because they have the option, of course, just to walk away or to speak to the authorities about what they see, but they also have the position of being able to twist the price down to something that suits them a lot better. It's also in their interest when they're buying a business to do their due diligence to ensure they're not buying into an entity that has the risk of indictment on any criminal matters. So in conclusion, although it's conceivable that there are cases that are not considered in this analysis, it seems clear that the action of cheating on taxes, it may provide the business owner with some benefits in the short term. That's assuming, of course, that they're able to continue in this manner of business without detection. However, the practice is certainly not beneficial for them in gaining a higher sales price for their business when it comes time to on-sale. So thank you for taking the time to look at my report today. Goodbye.